Hello, and welcome to today's webinar presented by Fergasso Financial Advisors, where our topic is Navigating Employee Stock Option Plans. I'm Lindsay Bisciotti, Executive Assistant and Events Coordinator at Fergasso Financial Advisors, and I will be serving as your moderator today. Thank you all for joining us. Now I would like to introduce today's presenters from Fergasso Financial Advisors. Brandon Schwan, Vice President and Financial Advisor. Brandon began his career at Fergasso in 2012 as a portfolio manager and later advanced to a financial advisor in 2015. He is now Vice President and Financial Advisor. During his career at Fergasso, Brandon has excelled in the areas of business development and client relationship management. He takes pride in helping clients formulate unique financial plans to help them realize their financial goals. Michael Furtig. Michael is Senior Vice President and Financial Advisor. Michael has been in the investment industry for over 25 years. He works at Fergasso in the following roles: as the manager of our Cool Springs branch and as a Senior Vice President and Financial Advisor. His key responsibilities include working with clients on the creation and implementation of financial plans, asset modeling, review meetings, and ongoing communications. Mike is also a very experienced presenter. He was a co-host of Fergasso's radio show, The Advisor, in 2017, and he has been providing financial education for 20 years. With that, I'm going to turn it over to Michael to get things kicked off for us.
Thank you, Lindsay. And let me first just say a quick word about Fergasso Financial Advisors. I just want to kind of mention our mission statement, which has been and continues to be to guide our clients toward the realization of their goals through holistic financial planning and investment management. And we do that with an uncompromising commitment to trusted, personalized client relationships. That's part of our core value. So you can see just a little bit about the firm, the assets we have under management, the clients that we serve, the fact that we do have an outside board of directors. We are an ESOP plan that helps to ensure the firm's perpetuity. We do not deal in proprietary products, and we do work within a team-centric structure to help to provide for the firm continuity. I'm going to first welcome everyone again to this webinar, and let me just go through the agenda so you have an idea of what it is we're going to talk about today. You know that we're going to talk about employee stock option plans, but we're also going to talk about the importance of getting qualified guidance when you're dealing with this subject. There's a lot going on. We're going to go through a glossary of terms. We're going to talk about types of stock option plans and their differences. And then we'll look a little bit at trends in executive compensation and how do you match the stock option strategy to the need that you may have. And we're going to start at the beginning and talk about what employee stock option plans are. But before I describe that, let me first just kind of tell you that today I'll be doing a lot of the setting up, so to speak, and Brandon is going to do a lot of the knocking down. So my part may be a little more academic. Brandon will turn to the more practical and functional aspect in terms of how this information can be used to help those who may be faced with the prospect of equity-based compensation. And we're going to jump back and forth a little bit just to keep everybody on their toes. So let me get back to the initial question. What are employee stock option plans? These are plans that companies use to both attract, retain, and compensate the types of employees that they want. And these plans are simply contracts between a company and its employees. They give the employees the right to purchase a certain number of a company's stock at a fixed price within a certain period of time. Another seemingly obvious question, but I think one that we have to address and understand is, why would a company issue an employee stock option plan? You know, you've heard about the 401k, the IRA. Why would we issue an employee stock option plan? Again, it would be to attract, retain, and motivate the high value employees. When you can link the company's performance to an employee's compensation, you get some real benefits, including providing pride of ownership to the employee. For the company, it helps them to reduce out-of-pocket compensation costs. Another seemingly interesting or obvious piece is, well, how much of this employee stock option is going to be involved in my actual compensation? We think that that's something that's going to continue to increase over time. And in fact, these plans are becoming more and more prevalent. And so it's starting to make up a much more substantial portion of compensation, especially for executives. This graph illustrates exactly that. In some cases, you'll have an executive who is going to forego salary altogether and tie 100% of their compensation to stock options. Now, that's certainly one way to prove that you have a vested interest in your company, and not every executive is going to tie 100% of their comp to stock options, but some will. And we believe that these stock option plans are going to continue to play a more substantial role in overall compensation into the future. Let's face it, most executives are really good at what they do. Probably the reason they've landed in the top role or one of the top roles in the company, but they might not be all that knowledgeable about the nuances of stock option plans and awards. So they need guidance. And there are lots of reasons that they might not be knowledgeable. It might be because this is the first time they're dealing with it. So there's a lack of experience. Even if they are dealing with it, the reporting isn't always all that frequent. There are confusing documents involved. There are complex and various tax issues to be dealt with, and we're going to talk about several of those today. Lots of alternatives, certain lockups that are involved. Sometimes there are limited trading windows, so we have to make sure we get it done in a certain period of time. Otherwise, we lose the opportunity. There are also some pitfalls, including what we call emotional bias, tax ramifications, the tendency to delay. Why do we delay? Because we don't understand. We don't know what to do, so we just put it off. And a lack of coordination. Let me jump back to one that I jumped over, which is concentration risk, and tell you that I could sit here today and tell you lots of real life stories about people who got caught up in being overly concentrated within a certain position. If you just think about the news stories we've seen over the last decade about big name companies that have either gone belly up altogether or have just lost significant value over short periods of time. It happens. Over concentration with the stock of the company where you work is a phenomenon that happens more often than it should. And I think that's true in large part for one big reason, and that's that familiarity breeds overconfidence. So let's not confuse the familiar with the safe. Employees are sometimes overconfident regarding the outlook for their own firm because they know it. It's familiar. It's similar to being over-concentrated in an investor's home country, which is something that we call home country bias. We need to avoid those things. And there are several things that can be done to help you with an over-concentrated position. And Brandon's going to walk us through several of those options as we continue with the webinar today. So we think that there are several things that need to be addressed and looked at when we're working with someone who has stock options in the mix. We try to convey right at the very beginning the importance of putting together what we call your own board of directors. You know, that would include the attorney, the accountant, the financial advisor, a banker, maybe others, all of these people who can come together on your behalf to help you with whatever the objectives are that are most important to you. Are you interested primarily in protecting your wealth, maximizing the value of what you have, providing liquidity? Maybe it's, I need to minimize my taxes, I need to produce income, whatever those items are. And then you can start to prioritize what's most important all the way down to least important. Then you get a sense for starting to build the plan to get you to your primary objectives. So let's dig into just some of the general concepts and terms that we're going to hear about today. But some of these are pretty self-evident, like the grant date, which is simply the date the employee receives or is given the option. Then there's the vesting date, which is the date you can exercise the option. The exercise date is the day you actually do exercise. And then the expiration date. That's the date by which you must exercise the option or they'll expire. And there's lots of studies that are done on options. One of the big takeaways when I read those is that typically about a third of these options expire worthless every year. And it's simply, again, because people didn't understand or just missed the window of opportunity. Then you're going to see three terms that all mean the same thing: strike, exercise, and grant price. They all can be used interchangeably, but they all mean the exact same thing. It's the price at which your employee stock option plan allows you to purchase the stock. And then finally, this thing called bargain element. It's the difference between the exercise price and the market value. Think of this simply as the profit on the position. So we're going to talk about really three types of plans today, including non-qualified stock options, incentive stock options, often referred to as ISOs, and restricted stock. Let's begin with the non-qualified stock option. These are, first off, the most flexible of the options, and they're fairly common. Because of the flexibility they provide, they're not the most favorable from a tax standpoint, and Brandon's going to illustrate that in just a minute with an example. But let's remember that these are rights that are granted by an employer to a participant. And that, I use that word on purpose because it doesn't necessarily need to be an employee in the non-qualified stock option world. But they are rights that are granted to an employer, by an employer to a participant, to purchase shares of the stock at a fixed price over a certain period of time. And as I said, they don't qualify for some of the more favorable tax treatment we're going to see with ISOs. But Brandon, walk us through an example of what the non-qualified stock option looks like.
As Mike mentioned, because of that flexibility, these aren't taxed as favorably as other options. And you're going to see this as a recurring theme in the examples that we go through between the flexibility and the taxation of options. But for this example, we're going to go through the non-qualified stock options. Mike highlighted some of the major terms that we're going to go through, which you'll also see on the following charts. But on the bottom axis, you can see that the grant, exercise, and sale date are all highlighted there. Now, with non-qualified stock options, in this case, a share is granted at $20. After about 3 years to the exercise date, the appreciation of that share goes to $50. That bargain element or profit on that position is taxed as ordinary income in the year in which it's exercised. So it'll increase the tax burden of the individual that exercises these options in that year. Now, for whatever reason, this individual also says, I don't necessarily need the money, I'm going to hang on to the position, or they just have good long-term prospects for the stock. So if after exercise, that capital gains clock starts. And you can see that they end up selling the position 2 years later with an additional $50 a share appreciation. This additional $50 a share appreciation is taxed at a more favorable capital gains rate, typically between the tune of 15 to 20%, depending on where the individual falls in their tax bracket.
Great. Let's turn now right to the counterpart of the non-qualified, and let's look at the incentive stock option. Here, we're going to find the most restrictive type of option. So we went from the least to the most, but these are still somewhat common. When you see incentive stock option, you usually think tech startup, firm where cash compensation is maybe low, but stock options are pretty plentiful. And these are rights that are granted by the employer, in this case, to an employee and only an employee to buy shares. They also must meet certain requirements called the qualifying disposition in order to enjoy the favorable tax treatment that Brandon's going to talk about in a minute here, and just walk us through this example of what the incentive stock option looks like.
Since these are the most restrictive, like Mike mentioned, the taxation of these could potentially be the most favorable if that qualifying disposition definition is met. And in order to meet that definition, what you need to do is receive these shares and then hold 2 years from grant to exercise, and then an additional year from exercise to sale. So if you look at the dates at the bottom, this example has met that qualifying disposition. Now, also, we can see that these look relatively similar to the previous chart, but that bargain element or profit on this position of that $30 a share isn't realized as ordinary income, but is looked at as an alternative minimum tax or AMT preference item for the 2018 tax year. Depending on where this individual falls in their relative tax bracket, that could substantially increase the amount of federal tax due when they end up filing for the 2018 tax year. Now, since that qualifying disposition is met, you can see it's treated much more favorably from a taxation perspective, and the full appreciation above the initial grant price of $20 would then be treated as capital gains. So $80 appreciation on this share would then be treated at a much favorable rate compared to ordinary income, like we saw with the non-qualified stock options in the previous example.
Right, we tried to create a chart to just kind of help you quickly compare the non-qualified stock option to the incentive stock option, and then you see that here. I don't have to read the chart at you, but I do want to highlight just a couple of the elements on this. The first is going to be the transferability aspect. This can become really important in terms of a planning opportunity, as we'll discuss in just a little bit. Let's remember that incentive stock options are only transferable at death, while non-qualified stock options can be transferred during your lifetime. Let's also keep in mind this thing called the $100,000 rule. That's going to pop back up a little bit later, and we'll see exactly what that means and how it applies. But let's turn now to finally our last plan type and talk about restricted stock. And we're going to focus on what are called restricted stock units because they're the most popular form. Most executives today are receiving restricted stock units in some form. They've overtaken all other types of stock options. So restricted stock is stock of the employer issued to employees in connection with the performance of services. The stock is restricted because it's subject to forfeiture in the event certain conditions aren't met, like continued employment. Restricted stock units always retain some level of intrinsic value because the basis is zero, right? So unless the company goes under, there's going to be some value left to the stock. So Brandon, walk us through an example of what the RSU looks like.
Since RSUs are always going to have value due to that zero basis, they're going to be last on the list when it comes to favorable tax treatment. As you can see in this example, the grant, vesting date, and sale date are all similar compared to our previous examples, but in this case, upon vest, the full amount is realized as ordinary income, so $50 a share. Also, this individual wants to hang on to that, so they're going to start the capital gains clock after vest. Any appreciation is then taxed at capital gains rates. As you can see in this example overall, this could be very favorable to the individual as a large part of their compensation can take part of this. And from that bar chart that Mike went over earlier in the presentation, upwards of 60% of executive compensation is in the form of restricted stock units.
Yeah, we tried to do the same thing here just in terms of a quick comparison chart. So here's another comparison where you can see the major differences between restricted stock and employee stock options. Again, I'm just going to point out a few items of note, including the vesting schedule. And you've probably somewhat familiar with a vesting schedule. They apply to all types of retirement plans. They also apply to these types of employee stock plans. But typically here, you're going to have one of two vesting schedules, either a cliff vest, where you don't vest at all for the first 3 years, and then you're 100% vested, or a graded vesting schedule, where you vest at 25% per year for 4 years, and then you're fully vested. Let me also point out this other thing called the 83B election option. Probably one of the more complex topics that we're going to talk about today. Brandon's going to cover that in a little while, but that's an important piece to remember, especially if you've got some employee stock options to be dealt with, because it can be a really favorable win if you understand what that election is. So we've learned a little bit about the various types of plans that are out there, but how do we help someone who might come into a situation where they have options as some portion of their compensation? Well, we start at a pretty obvious place. We try to determine what the objectives are for that individual. And we do that by walking through a set of discovery questions. What is it that you really want? What's the primary objective for these assets? Do I want to minimize taxes? Do I want to grow the value, reduce risk? What will the assets be used for in your overall financial plan? Are these going to be strictly for retirement? Is there some other business reason? Is there some charitable intent with this? And then we talk about what your view of your company stock is and why. And again, this goes back to some of that bias that we talked about before. Maybe we don't accept an answer like, well, this is the greatest company ever, especially now that I'm here, and it's only ever going to go up in value, et cetera. Maybe we need to get a third party to analyze and appraise the value so that we get a better understanding of what that value is. Then we talk about, how do you see your role within the company? Well, if this is just a stepping stone and I don't plan to be here all that long, well, then that's one direction. Or I hope this is the last company I ever work for. I plan on being here for the rest of my career, et cetera. That gives us a different path. Then we talk about the exit strategy that you have for these positions. And we ask questions like, if you didn't work at this company, how much of their stock do you think you'd just go ahead and put in your own portfolio? Or said a little differently, if we presented you with cash equal to the value of your current stock position, how much would you allocate to your company stock? Once you have the answers to these questions, you can start to map out the most appropriate strategy for yourself. So I'm going to now turn this presentation over to Brandon so he can talk about matching the most appropriate strategy to the need that you have.
Based on the questions that should be asked to help determine your client's goals, based on the previous slide Mike went over, these are really the 5 major matching strategies that we're going to go through to help them reach what they're trying to accomplish. The first one we're going to review is liquidity. Liquidity is pretty simple. You're trying to determine the best way to turn shares into cash, and this is best done through exercise and sell. Considerations that have to be looked at for this are, is cash available to pay for the stock and taxes? In most cases, cash doesn't necessarily need to be available to pay for stock because cashless exercise is likely available to be used. In cashless exercise, as you can see in the second column, the broker-dealer lends funds to cover the cost of exercise, and then there's the simultaneous option in exercise of stock sale. So as you can see here, stock cash necessarily doesn't need to be there to pay for stock, but there's always going to be the tax burden associated with this. So you have to make sure that cash is available to pay for any type of tax burden. Now, there's always going to be the risk of remaining in the stock, and there's always going to be the opportunity cost of locking in current gains or forgoing further appreciation. The main strategy triggers that we look at during exercise and sell is the time-based option, the price-based option, or the tax-based option. These are not mutually exclusive, and if there's a very large position, we can come up with a strategy that marries all of these to help fit your needs. The first is time-based. Mike mentioned earlier that almost a third of stock options go unexercised. So that's a lot of value that someone could be leaving on the table. This can remove that completely. So the typical expiration is 10 years from grant. And really what we're looking at doing is exercising these in later years in increments so that at the end of expiration, there's no shares left. So for the first 6 years, we're just letting the stock fluctuate with whatever it does. The last 4 years, where we're going to take out 25% chunks and exercise that over those 4 years. So at the end of 10 years, you're going to not have any stock left in this position. This really takes out any type of emotion as to when to sell, and then also reduces the poor timing risk. This could be looked at as kind of dollar cost averaging out of a position. We all dollar cost average in through 401ks or any other type of investment account in which we're making regular contributions to, but this will help smooth out returns since you're going to be selling at different prices. The price-based option is more quantitative and requires a little bit more research and analysis in order to determine price targets above the current share price. So in order to come up with this strategy, we're going to determine what is an appropriate stop price or a price below the current market price that we will not sell any shares whatsoever. And then on the upside, we'll do some analysis, likely with an investment analyst, to determine medium, short, long-term goals as to what we think an appropriate price is, and then allot a certain number of shares to be sold at those different price targets. The last strategy is going to be based on tax bracket. Most executives are going to fall in probably the top 2 tax brackets just based on how their income is received through their salary, bonus, and a lot of restricted stock units, which could increase their income in certain years. A form of restricted stock units is performance stock units. These are received based on both individual performance and company performance. So this could be a very dynamic conversation that needs to be had alongside your tax professional to determine if 1 year makes sense to exercise options versus another. Say an individual's performance was fantastic, but the company didn't do so well. So the performance stock units on that side might not have come through, which could lower the tax bracket, say, than maybe the previous year where both individual and company performance were great. Hedging is the next strategy that we're going to go through, and it's mainly used if a person has a very large position they want to hold on to, but doesn't want the downside risk of just holding the position outright. And the example we're going to go through is a zero premium collar. And like I mentioned, the investor in this case wants to reduce the downside position while also deferring capital gains tax going forward. This is done through the purchase of a put option below the current market price, so it gives you protection on the downside. And then you're simultaneously selling a call option above the current market price for the exact same premium that was paid for the put. Hence zero and zero premium collar. You don't have any cost out of pocket for this strategy. And as with any option strategy, it allows the investor to specify option maturities and the degree of upside or downside exposure in the individual position. So here's an example of what this actually looks like. And round numbers are obviously going to be the easiest. So the stock price in this case is trading at $100. We purchase a put with a strike at $90. So if the share were to decrease below 90, we're completely protected from that decline. And then we sell that call on the upside at a strike of $125. But if the stock appreciates above that, we're going to forego any type of appreciation. So we're range bound in this $35 range. Mike mentioned earlier how there's always that concentration risk. And some people might have that emotional bias as well, where they just think the stock's going to continue to increase. Maybe they're not willing to sell it. If that's the case, this could be a very good strategy to help protect yourself if we were going to go through another downturn or if a company were to go through troubling times. Diversification is the third strategy we're going to review. And this makes sense for someone with a large position that may have a very low basis. Maybe they bought something a long time ago that's run up significantly in price, and it's just not easy to liquidate due to the tax complications that it could bring. The most complicated way to diversify away from a stock position is a variable prepaid forward. And really what this does is marry that zero premium collar we just reviewed with a stock loan. So this monetizes that concentrated stock position without selling the shares or recognizing taxes. And how this functions is that there's always going to be a lending institution, it's typically a bank, and you're going to receive 80 to 90% of the stock value back to diversify away from that position. Also to note, these can bring extreme IRS scrutiny, so they need to be examined alongside a wealth advisor with a tax professional in order to make sure that these are done properly. So you can see this chart looks really similar to that zero premium collar. So the stock price is the same, but due to that finance charge and what the lending institution charges, the break-even price is going to be a little bit different. The typical variable prepaid forward is a 3-year time frame. So if we're going to use round numbers, I'm going to go on the higher end, but if there's a $10 million position, you can monetize $8 to $9 million of that. And you're free to do with that whatever you'd like. Now, at the end of the variable prepaid forward, that amount has to be delivered back to the institution in either the form of cash or securities. So if you diversify away from this position and you get a large amount of appreciation, say it goes to $12 million, you're in the clear, you made money. But if it declines to $6 million, you're obviously on the hook to deliver money out of pocket back to the institution in order to recoup the amount that was originally lent. A much simpler way to diversify away from a large position and capital gains at the same time is through an exchange fund. And we have quite a bit of experience with this, but in order to participate in this, you have to be both an accredited investor and a qualified purchaser. So the hurdle rates to get into one of these, which I'm going to go through an example on the next slide, are a little bit higher. You have to have a liquid net worth of over $5 million if you're an individual, and also hit certain income limits depending on your marital status. Also, if you're a corporation, trust, or partnership, you can participate in one of these, but you can see that it's a $25 million net worth in order to enter into one of these exchange funds. So this is an example of what this would look like. This individual has ABC stock with a fair market value of $1 million, but a very low cost basis of $100,000. A lot of these exchange funds have to be done through a bank, like a Goldman Sachs type bank, and they're all run by individual managers. So it's at the individual manager's discretion if they're going to accept the position. So if ABC stock is something that's widely held by a lot of investors that's appreciated significantly, the manager has the ability to turn away the individual because they're already allotted to their amount in this exchange fund. But for this example, ABC gets accepted. It then goes into this basket of stocks where there's no liquidity for 7 years. So you have to make sure that you're okay with essentially making this stock illiquid for a 7-year time frame. After that 7-year time frame, the post-portfolio exchange, you get a certain amount of stock back, but you can see it's different names than what you originally put in there. This is also at the manager's discretion. The value of that basket of stocks has doubled since the initial investment 7 years ago, but now the basis is spread around between all the individual positions. So if you don't like one stock, you can sell that and realize much less of a capital gain than you would have if you were to just sold a portion of ABC. Many of you have a large amount of wealth or concentrated wealth and want to ensure that you're taking care of your family for generations. Leaving a legacy is very important, and Mike's going to go through some of the specifics of this topic in wealth transfer.
Thanks, Brandon. Let me take us back to one of the earlier slides. Remember when we talked about the transfer rules for non-qualified stock options and the ISO, the incentive stock options? You'll recall that the ISOs can only be transferred at death. That doesn't make them the greatest in terms of a planning opportunity. But the non-qualified stock option can be transferred during your lifetime. That makes them a great potential candidate for gifting to family if that's something that's important to you. So let's use this example. I have a bunch of non-qualified stock options. I want to do some estate planning. I can accomplish a couple of things. First of all, I can reduce the value of my own estate and shift the future appreciation of that asset out of my estate, while at the same time transferring my basis to a family member who might be in a lower tax bracket than I am. In this example that you have on the screen here, I have a married couple who have 3 children, who then each have 3 children of their own. And you can do the math just like I did to see how this works. But you're going to see you can get a significant amount of money out of your estate by, in this case, just using the annual exclusion, which as of right now is $15,000 per person per year. The point is, you could potentially get a bunch of things accomplished if you plan ahead and have the proper strategy in place. We'll also talk to you about this thing that, we call it the charitable toolbox. What I'll say about that is you should be working with the various experts, whether it's the attorney, the accountant, the financial planner, or better yet, all of those folks in tandem to develop the best strategy for your situation. You can see from this chart, there are many, many options available in this charitable toolbox. You have all of these possible solutions. The more your board of directors understand your goals and objectives, going back to those discovery questions that we talked about, the better prepared everyone can be to offer the solution or solutions that would work best for your particular situation. Brandon's going to now walk us through some of the gifting deductions so we can start to get a sense of what this means from a tax standpoint.
Direct gifts are the most straightforward way of gifting, and it all depends on the form of property that is looking to be gifted to what type of organization as to what the deductibility is. So you can see public charities are different than private charities, and you might say, well, what's the difference? A public charity is church, synagogue, American Cancer Association. Private charity is typically a fraternal organization. And like I mentioned, cash is the most favorable, but since we're focusing on long-term gain property with stock options, we're going to look at this long-term gain right in the middle here between fair market value and that 30% or 20%, depending on if it's a public or private charity. So just something to keep in mind as we go through the next few examples. Donor advised funds have become much more prevalent in recent years, and it's a great way to get kids and grandkids involved in philanthropic giving, since these can be written to last more than just the donor's lifetime. And really the strategy for this is to gift appreciated shares, and then this provides that tax deduction on those contributions based on the deduction limits we saw in the previous slide. And since we're typically going to be gifting property that has long-term gains associated with it, this can be looked at as really your own individual charity. So any amount that you end up selling, once it's in the donor advised fund, isn't realized as a taxable perspective. So There's low administration costs to this as well, and you have the flexibility to gift from this to various charities once it's set up. Charitable remainder trusts are also more common now, and it's looking for someone to create an income stream. So in the previous example of a donor advised fund, it's an irrevocable gift, and it's just strictly used to donate to charities. A charitable remainder trust is a donation of stock or whatever property you decide to gift into it, and that could potentially create an income stream for you. It all depends on the type of charitable remainder trust, being the CRAT in an annuity trust, which gives you a fixed dollar distribution, or a charitable unit trust, which gives you a fixed percentage of the account value per year, which is typically around 5%. The reason these are more common is that there's a portion of the IRS code and a section called the 75/20 rate. And the reason this is, the interest rate on this is so low that the discounting factor when you're looking at creating that income stream is more favorable and can create a little bit more income if these are put into place. The last strategy we're going to review, and likely the topic that's most impactful immediately, is looking at taxes and how to go about minimizing those depending on the type of stock that's received. Mike mentioned the $100,000 rule earlier for incentive stock options, and this is an example of that rule and a potential pitfall. Also, if we remember from earlier, ISOs are the most restrictive, but can also be treated the most tax favorably. In this example, we have 4 different grants, all in different years and for different amounts with a 5-year vesting schedule. So you can see, take a peek at the totals column. For the first 3 years, the way that these are vested, we're under that $100,000 amount, and assuming we meet that qualifying disposition definition that we went over earlier, so that 2 years from grant and then an additional year after vest, we get that long-term capital gains treatment. So that full amount in those first 3 years, we're fine. Well, we're above the $100,000 amount in the following 3 years. So, oh man, what happens here? Well, that amount above the $100,000 amount is treated as non-qualified stock options. So it's considered disqualified. And as we remember, as non-qualified stock options, the amount is treated as ordinary income, which will significantly increase the tax burden for the individual. Mention the qualifying disposition, and you can see the strategy that we're looking at with stock that meets the qualifying disposition is to create somewhat of a rolling strategy in order to pay for taxes for options exercised the previous year. And the goal of this is to recognize long-term capital gains while avoiding alternative minimum tax, which will increase the total amount of federal tax due. So really the strategy with this is to exercise ISOs in the first quarter of the first year. This could potentially trigger AMT tax due by tax day in year 2. What we're looking to do here is then sell stock before April 15th of year 2 to pay for the taxes due from the stock exercised in year 1. And we're just going to go with this through this rolling strategy where essentially you're going to sell in increments to pay for the tax burden for the stock exercised in the previous year. The 83B election is probably one of my favorite things to go over because it's one of the most overlooked ways to help clients in starting that capital gains clock earlier on a position. And this is available for both employee stock options and restricted shares. Note that it's not available for restricted stock units, and that's because the basis of those is 0. Now, this option must be specified in the plan document, and it has to be elected pretty soon after the shares are granted, typically within a month. The stock is subject to control and resale restrictions as well until vesting. And the way that this works is that restricted shares are generally taxed at ordinary income rates at vest. And the investor is choosing to turn that capital gains clock on sooner in order to realize more favorable tax rates down the road. Now, here's an example from a chart perspective, and I'm going to go through some specific numbers on the next slide as to how this could impact someone in a real life situation. But with this, the top bar chart is if we use the 83B election. But it's important to note the dates and the dollar values on the bottom axis. So you can see the grant, election, exercise, and sale date. Now, with the 83B election, we're electing that within 30 days of grant. So the appreciation of that of $2 a share is taxed at ordinary income rates. And we're assuming top ordinary income bracket as well as top capital gains tax rate for this example. So we're realizing that ordinary income earlier of $2 a share, and then we're turning that capital gains clock on. So the appreciation until sale of $40 a share or a $28 a share appreciation is taxed at a much favorable rate. Now, for whatever reason, the next example, this individual maybe doesn't know that the 83B election is available. So the full appreciation from grant to exercise of $20 a share would be taxed at ordinary income rates of nearly 38%. After they exercise until the sale of $10 a share, we're then taxed at capital gains rates, which you can see is more favorable. Now, with how this shakes out from a numbers perspective, on the left-hand side, we're going to look at the without the 83B election, and 10,000 shares are granted at $10 a share for a $100,000 value. No taxes are due at grant, but upon exercise, the appreciation to $300,000 is taxed at ordinary income. You can see that amounts nearly $76,000. Then, after exercise until sale, that's taxed at the more favorable capital gains rates. So if we add those two numbers up, total taxes due is right under $100,000. But if we go with the 83B election option, you can see at grant $100,000, no taxes are due at that point, but within that 30 days, there's a $2 share appreciation. We're going to pay ordinary income on that $20,000 appreciation, which is right under $7,600. Now, we then let the shares appreciate $28 a share, and that amount is taxed at capital gains rates, which is $66,640. If we add those two numbers up, we're right over $74,000. Now, if we do the quick math between if we were to use the 83B election or not, what's the benefit of it? And total tax savings in this case is over $25,000. So this could be very impactful if this is available to you and you think that there's a long-term growth prospects of your individual company. It's important to look at all of these strategies to help you realize what you're trying to accomplish and what might fit your needs. And all of this can't be done unless each one of these members of what we call the board of directors is working for you, between someone like us, your attorney, your CPA, and maybe a private banker, someone else that's on this board of directors. And all of this really ties into how we codify our client experience and something that we've been building for nearly 50 years.
Yeah, and Brandon mentioned that client experience, and you can see what that journey looks like with this illustration. From the moment you call us and we start to talk about your goals, we do a really in-depth data discovery on your situation, and then create and review a plan that has been customized to you. Of course, if you become a client, then we do all these types of things where we continue to educate and keep you connected. We also, coordinate, as we've said several times, with your family and your other key advisors. Let me just say that as one member of your board of directors, our job really is to help to guide you through this process. And that's what we do at Fergasso Financial. We like to start the journey by talking about your goals. Those of you who are already clients know that that's where we like to begin. We have that discussion based on your objectives, your time frame, risk tolerance, and just your overall financial objectives. And then we like to build your personalized financial plan based around all of that information, and then continue to educate, update you on the progress that's been made toward those goals. We also don't mind becoming kind of the quarterback to help you coordinate all of those goals with, again, your family and your other key advisors. We're here for you. We take our responsibility very seriously. And if you, at any point in time, need additional information, if we don't have it, we'll reach out, we'll find it. I would encourage you to reach out to us so we can either begin or continue a dialogue if you have any of these issues in your life right now, because it's certainly something that's going to help you on the road to achieve your important financial goals.
Thank you, Brandon. Thank you, Mike. That was a very detailed and easy to understand presentation. And now we're going to get to the question and answer section of our session. So I have a couple of questions here, and the first one is for Brandon. So Brandon, the question is there a typical or common mistake that people make, especially when they're dealing with stock options for the first time?
Yeah, thanks, Lindsay. I think that really the major thing is, what are the overall tax consequences and how do different options function? As we went through incentive stock options, non-qualified stock options, restricted stock units, restricted stock, all of these different flavors of stock compensation all function differently from a vesting perspective to a tax perspective, and really just understanding the overall impact that could have on both compensation, and then after that compensation portion, how much taxes are due on that is probably the portion that we see needs to be examined in more depth, especially if you have an individual that is entering the C-suite levels for the first time. A very large portion of their compensation can be tied to those restricted stock units, which, as you saw in previous examples, upon vest is all ordinary income. If they're not used to having that as part of their compensation, they could be in one of those top tax brackets really quickly. And that's something that we can help strategize with alongside other professionals in that board of directors.
Thank you, Brandon. Okay, Michael, there is a question for you now. So the question is, how does someone go about incorporating stock option plans into their larger financial picture?
Yeah, that's a good one, because for some people, stock options can make up a major portion of their overall financial plan. I think regardless of how big or small this is, you have to start with those kind of discovery questions that we talked about. Determine what the primary objective is for those options. But then you do have to start to put a plan in place, and you have to include the stock option portion as part of your overall financial plan, because it's going to play some role. How large, maybe we don't know yet, but then we can start to run various schedules to help determine what strategy is most appropriate, what strategy is going to help you to achieve and get to your goals. And then you have to continue to track the progress along the way. You can't just kind of put the plan in place and forget it. So you've got to track the progress and then make necessary changes as needed along the way. And if you do all of that, I think you end up with no surprises. You'll get to exactly where you thought you were going to.
I want to thank both of our presenters today for providing such a thorough explanation of navigating employee stock option plans. And on behalf of Fergasso Financial Advisors, I want to thank you all for being a great audience, and have a terrific day.